Adrian, good morning. Thank you for joining us. Adrian, at a time when global growth is still anemic, Europe is in a problem, and US economic data has been mixed, what explains the recent strength in emerging markets, or for that matter, other assets as well?
Well, actually, I mean, we haven't really had much of a move in these asset classes. What we've tended to see is there's been a good move in some corporate bonds. We've seen a good move in EM fixed income as well. But general sentiment towards emerging markets is pretty poor at the moment, partly reflecting the concerns that you brought up with particularly the US data, which has definitely disappointed people. We've all been well aware of the European recession and the structural problems there. I think the other thing I'd highlight about emerging markets is people's confidence in policymakers, corporate governance has definitely diminished. That's been a big issue, particularly with the way policy has affected profitability of companies in China and Brazil.
Adrian, if I look at major bond prices, US treasuries are at a 200-year low, German bond prices are at a 500-year low, and the gap between European treasuries and the German treasury is nearing an all-time high. Do you think currently global money managers are pricing in too much of risk, and such high elevated levels of risk are unlikely to sustain?
Well, I'm very impressed by your data series. You can go back 500 years in Germany. Look, it's a very simple story, isn't it, that we have a regulatory environment that in fact forces many pension funds, banks, etc., to try and find the risk-free assets because the risk-free assets are more limited with only a few of the European bond markets being considered risk-free. Plus, in the United States, we have obviously U.S. Treasuries as the global risk-free asset. I think this is why you get distortions, and absolutely bonds are overvalued. But whether the trend that's causing Treasuries and German bonds to be overvalued is going to change soon is very much open for debate. I mean, the near term, the delta has been weaker economic data and slightly more euro area stress. So for now, bonds remain overvalued. But it's very important to understand that investors are willing to take risk where they can identify growth, in cash flows, and therefore would view the credit risk to be less of an issue. So we've got corporate credits in the U.S. doing well, very large flows into EM fixed income. But the opportunity set is relatively narrow, and I think that's why you get these very expensive bond prices.
Adrian, last month you were talking about as to how India is in a favorable position after months of turmoil, and it's good to be overweight in India now. Do you still maintain that stance?
Absolutely. India has a current account deficit. The current funding environment for emerging markets is good. I hear lots of questions about, how is emerging market going to be funded because of the problems in Europe? I think it's completely irrelevant to the EM story. There's plenty of capital globally. Lending money to the emerging markets looks like a good investment. These are growth places. You're far more likely to get your money back than you are perhaps in a place like Europe where the economy is contracting in nominal terms. So I like India and Turkey as the current account deficit markets. We were seeing a trend of a lower oil price. More recently, we've seen the oil price moving up. We view that as a sort of temporary move, a supply-side issue that will prove to be temporary, and we would expect energy prices and material prices to decline. Again, India benefits from that a lot. I suspect this results season is going to be very poor in India, but it will mark the low. It'll reset expectations. And remember, equities have been falling for 18-odd months, and they've been discounting this bad news. And what we should be thinking about discounting going forward is the stimulative effect of the weaker rupee, the interest rate cuts that we've already had from the RBI.
In general, if I map how Indian markets have moved in last 1 year, infra names, banks, rate sensitives, they have been underperformers. Defensive stocks, FMCG, pharma stocks, they have been outperformers. Do you think that trade orientation will now change?
Absolutely. I think the story is a stabilization at a lower level of growth, then begin to see some acceleration in growth and some improvement in profitability. And one should be in more cyclical stocks rather than very expensive defensives.
Adrian, do you think the policy paralysis curve, which has bothered local investors and global investors, that has now bottomed out in India?
Maybe the view is it can't get any worse. We don't expect much from policymakers, but when I talk to international investors, they're extremely pessimistic on the policy framework in India, so they're pricing in a lot of bad policy. Maybe there's a chance of an upside surprise, but that's not what our investment case is based upon.
Adrian, a very basic plank on which Indian markets have rallied this year is that Reserve Bank of India will cut rates. But given the way how crude prices have appreciated in the last 10-15 days and the fact that this time in India the monsoon is subpar, do you think the Reserve Bank of India currently has little elbow room to do rate cuts?
Well, I think one has to be careful about looking at central bank policy and cost-push inflation. You know, the issue with Indian excess demand has clearly gone away, judging by the weakness in the economic data. Whatever the RBI does is going to be irrelevant towards the monsoon or towards the oil price. So I think, if anything, there's an argument that they should actually be easing more if the consumer is having to suffer from higher food prices and also import of oil is going up. But as I was saying earlier, I suspect the move in the oil price is going to just prove to be temporary.
Adrian, but is policy paralysis not an eyesore? And if you are indeed overweight in India, what is it that you're building in by way of a policy move from the government?
Well, I was talking about that a bit earlier. Look,
right.
I don't see any policy response from the government, but when I talk to international investors, they don't have anything good to say about Indian policy. We're well aware of the policy paralysis in India. One assumes that that is already discounted in the equity market. And really what we should be focusing on is the stabilization in growth and the eventual acceleration into the second half. You know, despite what is going on with the monsoon, I think it's quite possible that you could get the sort of golden cross of inflation continuing to moderate and growth gradually accelerating. And that tends to be a very favorable environment for equities.
Adrian, so what really could challenge your conviction? You are convinced that in the second half of this year, earnings for Indian markets will improve?
Yeah, well, think about this more and how do stock markets behave? The stock market in India was extremely poor performer in the 2011 period. It was discounting this very bad first half earnings. As we travel through the second half of 2012, the market will be thinking about what's going on in calendar year 2013, and I'm reasonably optimistic about that. So remember, the markets look forward rather than reacting to today's information.
Apart from rate-sensitive stroke infra names, Adrian, where are you picking up your spots in India?
Well, I also think that the consumer names in terms of consumer discretionary, like two-wheelers and four-wheelers, are worth buying. Hopefully the result numbers are going to be reasonably poor, and that provides a bit of weakness, and I think investors should be buying into that. As you were commenting earlier, we have the chief executive of a big two-wheeler company giving very cautious guidance at this point in time. Always good to be buying into companies when expectations are cautious and low. The chances of making money are much higher from those points.
Adrian, you're referring to Bajaj Auto, but what about other majors which have global exposure, the likes of Tata Motors, because the dwindling export figure and the international sales figures as well by way of JLR has been quite concerning.
Yeah, look, I can't comment specifically on stocks and stock recommendations, but you know, as a broad point, clearly investors are more nervous about exposure I would say more towards the U.S. I was talking earlier that expectations have been extremely low with regards to European demand for a period of time. The delta in the last quarter has been poor U.S. economic data. So I think sectors that have a higher exposure to U.S. businesses perhaps have got more bad news for them than was priced in a quarter ago. So the IT industry would perhaps fall within that category.
So, Adrian, is the IT industry or the Indian IT industry going through a cyclical slowdown or perhaps a bigger structural slowdown?
Look, I think there's just a simple base effect issue here with the Indian IT industry. These companies are very large. They have a reasonable market share of the outsourcing market. Broad technology spend is very, very anemic at this point in time. So I think you do have this combination of just sheer scale and structural issue combined with cyclical headwinds at this point in time. You know, saying all that, if I'm sending out billing when the rupee is at 55, it's going to look like a better translation than when the rupee was above, in the 40s.
So, Adrian, has India bottomed out for the year? Do you think we could make fresh lows in the next few months?
I think India in isolation has bottomed out. We have lots of clients that are interested in hearing the Indian story at this point in time. It was a very poor performing market last year. It is a market that has derated versus where it used to trend. It is a market that offers reasonable diversity in companies. Most of those companies are private sector companies rather than China, where 75% of the stock market is state-owned enterprises. So yes, I think India is bottomed in isolation. Emerging markets remain highly correlated to global equities. There is clearly poor U.S. data, which could be continue to weigh on the S&P. And we do, as we progress through the second half, get closer and closer to the fiscal cliff. I'm afraid we're not terribly optimistic that Capitol Hill will be able to come towards a compromise before we end the year.
Adrian, before we wrap, last question. What is Adrian Mowat's big call for summer 2012?
My big call is to get long Mexico, get long Turkey, and get long India within emerging markets, as these are the markets where I think you're going to get the best returns and have got some of the relatively better macro trends.